A lot of gold people are like, oh, they're going to make it 10,000 tomorrow. Probably not. That's not their style. But their style is it'll be 5,000 in a year, and it'll be 6,500 in 2 years, 3 years. It'll be 8,000 in 4 years, and it'll be 10,000 in 5 years. And the S&P will have gone up from 7,000 to 11,000 or something. And yeah, S&P up in dollar terms, down in gold terms.
Besant was out last week talking about, we've got $1 trillion in gold. You probably saw him, but $1 trillion is not that much money when you're spending.
No, they have to do it at 3 times that price, at 15,000.
That's kind of what I'm thinking. 15, 20, 25,000. Now, okay, you can kick the can down the road maybe for another 10, 15 years.
Global monetary dynamics are pivoting sharply toward hard assets as major sovereign nations confront crippling debt loads and eroding fiat currency confidence. Central banks across the globe are quietly restructuring reserve management protocols to safeguard against systemic instability. Prominent macro strategist Luke Gromen alongside veteran financial analyst Clive Thompson highlight a calculated shift in global monetary policy, projecting gold will undergo a steady, multi-year upward repricing rather than an overnight spike. Based on key market indicators, gold is predicted to hit $5,000 within a year, climbing to $6,500 in 2 to 3 years, $8,000 in 4 years, and ultimately reaching $10,000 within 5 years. Meanwhile, although major equity benchmarks like the S&P 500 may advance from 7,000 to 11,000 in nominal fiat terms, real stock values will actually depreciate significantly when measured against physical gold reserves. From an independent macro perspective, this shift signals an unavoidable rebalancing where tangible store of value assets outperform paper claims. Furthermore, China's gradual policy of deploying physical gold to defend the yuan demonstrates how paper currencies are systematically designed to lose value against precious metals over time. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Let's say it goes back to 5,000, and okay. Eventually, because I also think part of it too, like the other thing about the Chinese is a very gradualism, right? They don't do big splashy things like the Americans do, right? It's very subtle, right? We drop bombs and wipe out, the family or the ruling family we're on. The Chinese are much more subtle than that, and they've done the same thing as it relates to gold. They were on the ropes a bit in the third quarter of 23. And what happened? Like they changed the rules a bit and spreads in Shanghai blew out. Gold premiums blew out. And we wrote a report at the time for clients are using gold to defend the yuan. And we were right. That's exactly what happened. It's basically, okay, the yuan's under pressure. We're just going to empty London and New York gold vaults until the pressure's removed. And it was, and it was. And they did, and it was. So, I bring that up by way of saying I don't think like they're going to be, a lot of gold people like, oh, they're going to make it 10,000 tomorrow. Probably not. That's not their style. But their style is it'll be 5,000 in a year, and it'll be 6,500 in 2 years, 3 years. It'll be 8,000 in 4 years, and it'll be 10,000 in 5 years. And the S&P will have gone up from 7,000 to 11,000 or something. And yeah, S&P up in dollar terms, down in gold terms. Because that's the one thing, the other thing that a lot of the China hawks like, oh, property's gone nowhere, stocks have gone nowhere. Tell me how gold's done in China. Because that's one of their biggest savings. It's also a huge capital base for the banking system. How's gold done? Oh, well, that's up 4x in the last 6 years. And oh, by the way, the same people looking for a collapse in the yuan against a dollar have completely missed a collapse in the yuan against gold, which is what's happening. And it's literally the way the system's designed for the yuan to fall against gold over time. So, because that's how they're internationalizing the yuan. They've said that repeatedly for 10 years, 11 years, 12 years. So that's how I think about equities. It's dollar terms, gold terms.
One of the ones which I've talked about, which I think is it's so obvious that they should do it. I'm surprised they haven't done it yet, but I guess they're waiting for a crisis, and that would be to officially revalue the Treasury's gold holdings to a higher price. Yeah. Simply by doing that, it will create money out of thin air. And there's more or less a precedent in terms of what they did on the 31st of January 1934, when they effectively did the same thing. They forced the Federal Reserve at that time to sell its gold to the Treasury at $20.22, and the very next day they raised the price to $35, screwing the Federal Reserve out of a 65% profit, which I don't know what the Federal Reserve had to say about that, but I guess if I was in charge of the Federal Reserve, I'd say, my God, the government's just stolen a bunch of money off me. But the Federal Reserve then got something in exchange, which is where we come to today. They got in exchange something called gold notes, which aren't redeemable in gold, and they're not redeemable in cash. In fact, they're not redeemable at all. They've got a dollar amount on them, but they are irredeemable, and they bear no interest.
What are they good for?
So they're not part of the national debt. So what happened was the government got a bunch of money, which in those days was gold, in exchange for a bit of paper, which is worthless, which is still on the Federal, by the way, which is still on the Federal Reserve's balance sheet today as an asset. Now, all they need to do to repeat that trick is to do a sale and repurchase agreement with the Federal Reserve, which can be done by legislation. That's what they did in 1934. They brought out, I forgot the name of the act, Banking Act or something like that, but they brought out the Gold Act. They brought out an act which basically told the Federal Reserve what they've got to do. But basically, a sale and repurchase agreement means that the Treasury sells its gold to the Federal Reserve in exchange for newly printed cash. So depending on the price they sell it at, they get a bunch of cash for nothing. They immediately buy back that gold 1 second later at the same price, but in exchange for gold notes. Don't forget, the gold notes have no redemption date, they bear no interest, and they're irredeemable, and they're not part of the national debt. So what's happened, the government, the Treasury, suddenly gets a ton of money for nothing, keeps its gold, and it can use that money to either reduce the current debt or to help with the current spending, so it doesn't have to borrow money in the treasury market. That in turn creates a shortage of newly issued treasuries, because there aren't any newly issued treasuries, and existing treasuries, as they're reaching maturity, are being paid off without having to borrow from Peter. So there's a shortage in the treasury market, so yields plunge, and after a while, when they're at the lower level, the government can start re-enter the borrowing market and borrow at much lower rates.
Wow.
Genius, huh?
Clive, I love that scenario. You know, Besant was out last week talking about, we've got $1 trillion in gold. You probably saw him, but you know, $1 trillion is not that much money when you're spending.
No, they have to do it at 3 times that price, at 15,000.
That's kind of what I'm thinking. 15, 20, 25,000. Now, okay, you can kick the can down the road maybe for another 10, 15 years.
Yeah, absolutely. It would buy them a lot of time.
Fascinating.
So maybe they're waiting for a crisis, and that's perhaps one of the contingency plans.
A powerful monetary mechanism to alleviate mounting national debt involves officially revaluing government gold reserves to vastly higher price targets, potentially between $15,000 and $25,000 per ounce. By executing a specialized sale and repurchase agreement with central banks in exchange for irredeemable interest-free gold notes, Treasury departments can instantly generate massive liquidity without adding to official public debt numbers. This strategic accounting maneuver creates an immediate scarcity of newly issued government bonds as public borrowing demands temporarily disappear. As maturing debt is paid off without issuing new Treasury bonds into capital markets, bond yields will plunge dramatically. Crucially, this strategy acts as a stealth balance sheet recapitalization, granting governments the leverage to re-enter credit markets at significantly lower interest rates. This maneuver effectively pushes the fiscal debt crisis 10 to 15 years down the road, while buying critical operational time for monetary authorities. Now, let's get back to the interview.
When you look at just the interest expense on the debt, plus the entitlements, you're nearly 100% of receipts. You throw on veterans benefits, you're over 100% of receipts. And that drives a very simple dynamic, which is once you're over 100% of receipts, with debt where it is, you can't raise taxes because it triggers a recession. You either print or you cut benefits. And when more you print, the more inflation goes up, the more inflation goes up, the more yields go up, the more yields go up, the less attractive, or the more inflation goes up, the less attractive long-term bonds are, the more you have to shift to the front end. The more you shift to the front end, the more inflationary it is, the faster the debt reprices when the interest rates go up. This is the spiral the US, the UK, Japan, and Europe are in. And being in this, it's a very recognizable spiral. We saw it after World War I in the UK, in Germany, in France. the US paradoxically took care of it the way the Chinese are taking care of it now, which is stand aside and let stuff fall in price, like housing. We had a huge depression for like 18 months in the early 1920s. Jim Grant did a great book on that. Look at the imperative of how this is being described, right? We can't afford to lose this. This is the new Cold War. China can't win, blah, 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 blah. And then look at the reality of the math. And to me, it's elemental. They're going to have to buy backstop bond. Like they'll just take over NVIDIA, right? NVIDIA's on the tape today guaranteeing, $250 billion of, I think it's OpenAI, some sort of data center here in Ohio, actually. And interestingly, NVIDIA's down on the day, last I saw, right? So NVIDIA is starting to trade down on guaranteeing other people's bonds. That's another signpost, right? That shouldn't be happening. And ultimately, I think Treasury or Fed will take over for NVIDIA, guaranteeing these things. They'll take over for SoftBank, and just backstop the whole thing. And it's, may not even be that expensive per se, but I think that's what's going to happen. And it'll be I think stocks go up on that. I think bonds go down on that. I think dollar goes down on that. I think inflation goes up on that. I think gold goes up on that. I think Bitcoin goes up on that. I think industrials go up a ton on that. So to me, it's just so crystal clear. That's where this is going. But again, Warsh is going to lose all credibility after it happens. And so will Bessent, right? Because Bessent will be running the friggin' Chinese economic model he's been complaining about for the last 15 years of his career. And that's fine. Like that's where this was always going to go. But just don't pee down my back and tell me it's raining. He told Congress that the Federal Reserve is not in the bailout business, especially not for the biggest debtor of all, the U.S. Treasury. Sorry, that was Gregory Ip at the Wall Street Journal. He did, though, append an escape clause. This is a direct quote last week from Kevin Warsh. Quote, in periods of crises like the 2020 pandemic and the 2008 crisis, central banks by design need to step into markets to create a fair price. End quote.
Okay, so we'll get fair prices.
Fair for who?
Yes, we'll get fair prices.
Yeah. So he's basically like, he's full of crap, to be blunt. Like he's going, when push comes to shove, he's going to play tough for a little bit. He's going to play harder to get, right? He ain't going to sleep with the markets on the first date. He's going to wait till date 3 when he has a crisis. Then he's going to be sleeping with them, giving them whatever they want.
When national interest payments and mandatory social entitlement spending surpass total tax revenues, sovereign financial systems enter an inescapable mathematical debt spiral. Attempting to hike taxes under heavy debt burdens inevitably triggers deep recessions, leaving aggressive monetary expansion and currency devaluation as the primary remaining policy mechanisms. As accelerating inflation forces debt to reprice at elevated interest rates, central banks will ultimately intervene by directly backstopping corporate bonds, technology infrastructure projects, and massive private sector debt guarantees during periods of acute economic volatility. In our analytical view, converting private corporate liabilities into state-backed obligations creates severe moral hazard while locking in permanent structural inflation. This massive liquidity expansion will trigger a dramatic repricing across global investment markets. Stock market equity valuations will surge higher in nominal dollar terms, whereas long-term bond prices will crater under persistent inflationary pressures. The purchasing power of fiat currency will fall significantly, pushing energy costs, raw commodities, and baseline inflation higher. Consequently, premier hard money assets including physical gold and Bitcoin will experience massive upward revaluations, while industrial sector stocks stand to gain substantial momentum as institutional capital flees paper debt. Despite official public promises to avoid corporate bailouts, upcoming systemic stress will inevitably force central monetary authorities to prioritize market liquidity over long-term policy credibility. Share your thoughts about this interview in the comments section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.